Well, this story is for anyone trying to understand why the current U.S. administration is delaying a trade deal with Canada.
No, look, we'll continue to conduct these complex negotiations in the best interest of Canadians.
Now, for context, you're going to need to know how Canadians got into this position in the first place, and then why the negotiation tactic of delaying a deal is currently in the best interest of the United States.
In Trump's defense, he did explain today why we're going after Canada.
I mean, I look at some of the deals made, I say, who the hell made these deals that are so bad?
So this story begins with COVID-19, when the world came to a standstill. Everything we knew about work, life, and stability was turned upside down.
There is growing concern at this hour over a possible outbreak of a mystery virus.
In order to soften the economic blow on families and businesses, central banks slashed lending rates to historic lows. Mortgage rates fell below 2%. That triggered a flood of home buyers entering the real estate markets that had previously felt out of reach. In just 2 short years, Canadians took on nearly $1 trillion in new mortgage debt.
More than 2 million Canadians were unemployed, and inflation was well below our 1% to 3% inflation target range.
And that brings us to 23 and 24. As the threat of COVID-19 began to fade, central banks, including the Bank of Canada, start raising interest rates. The problem with that, all those mortgages taken out during the pandemic are coming up for renewal. In fact, 60% of Canadian mortgage holders are facing renewal simultaneously at rates much higher than their original loans.
But the flip side of that is every single time those rates go up, you're injecting a little bit more pain into the economy. When we think about these changes, one of the first things we think about are people who hold a variable rate mortgage. But look, fixed rate borrowers are coming due too. 2/3 of mortgage holders in this country still haven't renewed at these new higher rates.
Now, with mortgages making up about 75% of household debt, rising food costs, healthcare, and energy, analysts began to warn that many, especially new COVID-era borrowers, might struggle under this financial strain. Effectively, it's creating a nationwide stress test on the stability of Canada's housing market.
When I'm feeling a little stressed, a little anxious, I like to do some tests.
Now, a stress test. It's a simulation. It's designed to evaluate how well a financial system, in this case, the Canadian housing market and banks, can withstand severe economic pressures. It tests whether homeowners can handle high mortgage payments, whether banks can absorb potential loan defaults, and if the overall system remains stable under stress.
From the financial capital of the world, the opening bell is going to ring in 5 seconds, and to be honest with you, we wish it wouldn't.
The last major national housing stress test for both Canada and the U.S. was during the 2008 financial crisis.
It was the worst day on Wall Street since the crash of 1987.
In the U.S., the collapse of the housing bubble, triggered by widespread defaults on subprime adjustable rate mortgages, led to a full-blown financial crisis and recession. Millions of homeowners faced mortgage stress they couldn't handle, causing massive foreclosures and a breakdown of a financial system.
One place where none of this banking drama is taking place is Canada. And that is the focus of tonight's Weekend Journal.
In Canada, thanks to stricter regulations and more conservative lending, the impact was less severe. And Canadian banks weathered the southern financial storm. And now we're being tested again in 2025 and 2026. Over 2 million fixed-rate mortgages are renewing. Many of those mortgages initially acquired at a rate of 1% or lower. So what do a historic amount of mortgage renewals have to do with delaying trade talks?
We'll talk about the housing sector. We'll talk about steel, auto, new sectors of the economy, including artificial intelligence, what we're doing in terms of making Canada competitive.
Every time a mortgage comes up for renewal, a Canadian family faces higher monthly payments and increased financial stress. This pressure builds with each renewal, tightening the grip on household budgets.
We don't need trees from Canada. We don't need cars from Canada. We don't need energy from Canada. We don't need anything from Canada.
Now just try to imagine you were in trade negotiations with Canada. The U.S. government knows Canadians are financially vulnerable right now. So by dragging out talks, they force Canada to negotiate from a weaker position day after day.
I think the other thing, too, is that, as we saw in today's inflation report, inflation in Canada is pretty well under control, which gives the Bank of Canada a fair bit of scope to cut interest rates going into the future. That's not going to be the case for the Federal Reserve. It's going to be under a lot more pressure.
Canadians have so far passed the stress test, including the added pressure inflicted by its closest trading partner, with projected defaults significantly lower than initially anticipated.
Just from the point of view of economic management, I think Canada starts in a better position.
But with these mortgage renewals stretching over the next 15 months, from early 2025 through to the end of 2026, Canada will face continuous increasing pressure. Each month, renewals bring higher payments for tens of thousands of families. And each day, trade talks are delayed, that economic strain deepens. This isn't just bad timing. Canada is being squeezed. The longer the U.S. drags out negotiations, the more vulnerable Canada becomes, forcing it to negotiate under mounting economic stress.
A major development tonight in Canada-U.S. trade talks. Late this evening, the federal government suddenly announcing it is now rescinding its tax targeting big tech companies. The Prime Minister is saying talks can now resume. This comes just 2 days after Trump abruptly posted online that trade talks were off unless Canada dropped the digital services tax.
But this tactic also has a timeline. If Canadians continue to pay their mortgages and pass the stress test, and if the U.S. doesn't complete a deal by the end of 2026, Canada may actually find itself in a stronger position, showcasing to the U.S. and to the world it can survive even the worst economic storms without the assistance of the United States. So, this will most likely put the pressure on both countries to do a deal sometime in 2026. One, to save Canada, and the other, to save face. For the Agents, I'm Tarek Hagamad.